On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets.
Hi team, let's talk about non-tradables inflation, what it is, why it's such a problem, and what it will take to reduce it. The Reserve Bank in New Zealand left the official cash rate unchanged last week at 5.5%, which is the highest we've seen since 2008, and that's where the OCR has been sitting since the last increase, which came in May of last year. The Reserve Bank's forecast track suggests that there will be no respite for borrowers until next year. Even though the economy is slowing more than expected, unemployment is rising more quickly than expected, and even though inflation has fallen to the lowest level in 3 years. The headline consumer price index, the CPI, that's our main measure of inflation, increased at an annual rate of 4% in the 12 months to the end of March. And the Reserve Bank expects it to finish this year at 2.9%. So that would see it just inside the Reserve Bank's target band of 1 to 3%. 4% now, expected to come to just under 3% by the end of the year. Now that's encouraging. However, that outlook is tempered by the fact that most of the decline has been driven by falling international prices, or tradables inflation, as the Reserve Bank calls it. And in contrast, domestic or non-tradables inflation, as the Reserve Bank calls it, is still far too high to provide any relief. Tradables inflation, the international stuff, is running at an annual rate of just 1.6%. So that's very low. It's come down a long way, and it is absolutely under control at the moment. However, non-tradables inflation, domestic inflation, is still sitting at an uncomfortably high 5.8% per annum. Now, non-tradables inflation makes up about 60% of the CPI basket, and that is where the Reserve Bank needs to see evidence of weakness before it is going to be willing to take its foot off the brake pedal, until it's going to be willing to reduce interest rates. So even though that headline inflation rate has come down from 7.3% and it's headed in the right direction, it's come down for the wrong reasons. It's been driven down by those international factors, and we haven't seen nearly enough weakness or nearly enough of a slowdown in those domestic factors. Now, it's no easy task to get non-tradables inflation under control. The domestic economy is much less competitive. Prices for many goods and services are linked to inflation anyway due to indexation, so there's a bit of a circular thing going on there. We have seen some progress on this front, but it's been very limited to segments of the economy that are typically more sensitive to tighter monetary policy and higher interest rates, such as construction costs. While we haven't seen the cost of building houses necessarily fall, the pace of increases has fallen. So building costs have slowed dramatically in terms of the rises that we've seen as a result of high interest rates that are biting. So that part of the non-tradables domestic inflation has moved in the way that we want it to. However, we can't say the same for rents, which are up 4.7% in the past 12 months, are up nearly 5%. That's a little hotter than expected. Rates, which are up 9.6%, and anyone who's had a rates bill recently will know what I'm talking about. We've seen some parts of the country increase rates by dramatically more than that. And insurance as well. Insurance is up 14% according to the official stats, but in some cases it is up more sharply as well. And a higher OCR isn't going to help slow price rises in these categories, because higher interest rates do curb demand. They make us less willing to spend and they take money out of our pocket, so they do impact discretionary spending. But council rates, insurance costs, rents to a degree, those things are less sensitive to that higher OCR. So what the Reserve Bank has been doing hasn't been working too well to hit those categories, at least not directly. And unfortunately, Those things are all, for most of us, unavoidable costs. However, many people would argue that these are all lagging rather than leading indicators, and that there's an element of catch-up pricing that's been at play. Inflation has also been high across the domestic services sector, and this covers everything from healthcare and education to haircuts and hospitality, lots of parts of the economy, lots of things that we buy and use every day. Wages are often the biggest cost, or one of the biggest costs, in delivering all of those types of services. And that means to slow the price rises that we're facing as consumers, you need to see the labour market ease and wage growth expectations moderate. Remember that wage growth has been very strong over the last few years because we've had very low unemployment. And that's why the labour market is such an important piece of the puzzle, and why it features so prominently in Reserve Bank commentaries these days. Now, the unemployment rate has risen recently. It's at a 3-year high of 4.3% at the moment, and that's still below the 25-year average, which is about 4.9%, call it 5%. But at 4.3%, that is much higher than the multi-decade low of 3.2 that we saw a couple of years ago in early 2022. And that has made it a lot easier for businesses to find staff without having to pay over the odds to steal them off competitors. And that rising joblessness and that falling job security obviously aren't fantastic for households that are affected by that, but it does mean light at the end of the tunnel from an interest rate perspective and an inflationary standpoint. We saw that in the most recent quarterly employment survey, where average hourly earnings rose at an annual rate of 4.8%, which is down sharply from the previous quarter. It was 6.6%, I think, the previous quarter, and that was well below Reserve Bank projections as well. 4.8% is what it came in at. The Reserve Bank had it higher than that. So that is still too high to be consistent with low and stable inflation. But forward-looking indicators do suggest that wage growth will keep slowing. The ANZ Business Outlook survey in April showed that firms best guessed their expectation for wage settlements over the coming 12 months had fallen to 3%, and that's down from about 6% 2 years ago. So it is coming down when you look at some of those forward indicators. When those more realistic expectations become entrenched in the minds of workers, I think you will see price setting behaviour from companies follow suit. So there is that path to lower non-tradables inflation. We will get there, I hope. It's just going to take a little longer than we thought it would, and there could be a few more bumps along the way because we do need to see unemployment rise. Unfortunately, wage growth expectations decline and the heat come out of the labour market. While that should lead to lower interest rates, it certainly won't solve all of our problems. Inflation is simply the rate of change, remember. So even if we do get to the Reserve Bank's 2% target, we're at 4% now, so it's still double that. Even if we do get to that 2%, prices will still be rising. Low inflation doesn't mean prices going down. Low inflation still means rising prices. It just means prices are rising by less. So even if you get to 2%, you're still facing higher costs every year. So that's really important to remember, because I think many households at the moment are frustrated not by high inflation per se, but by higher prices. And for the most part, we will be stuck with those higher prices. They will be here to stay, even when we do get inflation back to target, even when things have moved in the way that the Reserve Bank wants to see. All that will mean is that those price increases will be more moderate. I guess interest rates will take the pressure off a lot of people because our mortgage costs will fall if we have a mortgage, but for everything else out there, really important to remember that inflation is simply the rate of change, and low inflation or falling inflation does not mean lower prices necessarily. It simply means that inflation will be less and the rate of change in terms of those increases will be more subdued. Right, I hope that's useful. We'll talk again soon, team.
For more insights, visit craigsip.com.